like to welcome everyone to today's Boardroom Bites at 9. Our presenters for this morning is Jeremy Sampson and Declan Ahern. I hope I've said that right, Declan. Jeremy, I think, is no stranger to most of you that's on this morning. He's been very active in the media and he's currently the MD of Brand Finance Africa. He's got expertise in marketing, advertising, graphic design, public relations, reputation management, and branding. And Jeremy has also been part of the IDSA journey for many years. So I think he'll give you a nice also history and background as well when we start. Declan is also from Brand Finance. Declan's actually sitting in London, so he's joining us from London this morning. Declan's the valuations director at Brand Finance and has got extensive experience in management consulting, looking at data and analysis, market research, and business development. So Declan and Jeremy, I will hand over to you now, and I'll see everyone back again during the Q&A.
Thanks, Vicky. Well, good to be with you all. And on behalf of Declan and myself, good morning, wherever you are. Let's get straight to the chase. 30 years ago, if you looked at the accounts of any company, probably 80% of it would be tangible, the bricks and mortar, the factories and that sort of thing, and less than 20% or so would be the so-called intangibles. And that 20% was made up of a whole range of things, from copyrights, licensing, and brands. Fast forward 20 years, 30 years, and you often find now companies where 80% is made up of intellectual capital and only 20% or less the tangibles. And this obviously varies a lot. Go back 30 years ago, and that's roughly when I joined the Institute of Directors. And some of you would laugh when I say, well, I was asked by Richard Wilkinson to write an article on corporate branding back in about 1998. He said, there's one condition, Jeremy, you can't use the word brand, because it'll turn my members off. Well, hopefully 22 odd years later, that's not the case. Some 5 years later, I was asked to write an article on reputation. And again, that seemed to cause a little bit more interest than branding. But then over the years, working with Ansi Romalo, helping with the rebranding of the Institute, because remember, it was a sister of the Institute of Directors in the UK, and then we had the separation. So we created the branding that you now see top left of your screen for the Institute. And then I had the privilege of working with Herman Mashaba on the council of the Institute. So a lot of things have changed over the 30 years. And you can see that today, brands and reputation are indeed very important and very valuable. And that's something that Declan will go into in much greater detail, because you can now measure what a brand is worth. And then if we go on to the first slide of the presentation, you'll see there that we look at brand value, which is the financial value. And some people say, well, can brands be bought and sold? And the answer is, if they're separable, yes. In South Africa, we've had Jet Stores recently extracted out of Edcon and bought into another group. And then the brand strength side is, and you see over on the left-hand side, is all to do about the brand, its strength, its equity, its performance, almost its reputation, but a lot more than that. And that's where we build this all together. Now, some of these slides are fairly rich in content, but you're all going to be able to see these later on because you're going to receive a recording of this presentation, and then you can go through in greater detail. But I think the big important point to make is that Brand Finance, around for 25 years, London-based, is totally international standards recognized. As you see on the bottom of the slide there, recognized by brand valuation, recognized by brand equity, and our founder, David Haig, has actually been instrumental in putting these ISO standards together. On to the next slide. And this is where we're going to talk a little bit about why is brand reputation important. I think we're all very aware today that a brand isn't just one item, it's everything. It's from a person, your own personal brands, right through to the country where you're sitting in. And whether that's South Africa or Scotland or whatever, everyone has a reputation and everything in between. And that affects our thinking and our sentiments and whether we use that brand or not. But now I'm going to hand over to Declan because he's going to get into the nuts and bolts and talk in more detail about the financial aspects of brands. Over to you,
Jeremy. So I think everyone on the call is aware that brand and reputation is important, but people may not be aware that it impacts various stakeholders throughout a business and an industry, and not just customers. So what we have done is highlighted 5 key stakeholders here, and we're going to show you some examples using our internal data from various studies that we have run, where a stronger brand and a stronger reputation positively influences each stakeholder. So, of course, I think everyone would be aware that the consumer or the customer is strongly influenced by brand reputation. A strong brand typically influences consumer perceptions through brand equity and therefore influences consumer behaviors. A strong brand can generate higher consideration for the brand or product, which leads to greater penetration, higher frequency of purchase, what we call a price premium, so consumers are willing to pay more for a better brand, higher loyalty, so higher repeat purchases, and essentially a stronger brand cuts through the noise and provides more effective advertising for your product or your business. If we look a little bit closer at brand consideration, what you can see on this slide is that typically a 1-point increase in reputation leads to a 12.7% increase in brand consideration. And why is that important? Well, our research and research of our partners have found high correlations between consideration for a brand and an increase in base revenues or sales. So a 1 percentage point increase in consideration typically translates to a 0.5% increase in base revenue or sales for your business. And this is an important point to make, I think, especially for marketeers listening in today. If we look at another stakeholder in terms of financiers, our data shows us that stronger brands can borrow at cheaper rates. So essentially what we do throughout our study is we rate a brand strength as a score expressed out of 100, and that's using approximately 20 to 30 different metrics depending on the industry, which includes reputation. We then assign a corresponding rating scale, which you can see on the bottom of the screen, ranging from A- to AAA+. That's very similar to a rating scale that the likes of the S&P or Fitch or Moody's would provide. We then corresponded these ratings with the percentages each brand was able to borrow at. So that's debt financing. And what we can see here is that weaker brands on the far right of the screen borrow at a much higher interest rate premium than stronger brands on the left of the screen. Looking at another stakeholder, so that being the employee, for the last 2 years, Brand Finance has published a CEO Brand Guardianship Index, which we publish at Davos every January, in which CEOs are rated based on how well they protect and grow brand value and business value for their organization. As part of the study, we found an interesting correlation in which stronger brands could attract CEOs for a much lower annual fee. So what you can see on the y-axis here is brand strength as we rate each brand throughout our study. You can see the likes of McDonald's and Microsoft there. And on the x-axis, we have total annual CEO pay inclusive of bonuses. And what you can see is the weaker the brand gets, the higher the overall annual compensation. I think a very strong argument for why brand and reputation is important is if we look at the investor community. So what we're looking here is profitability and value growth and overall share price performance. Brand Finance actually runs an ETF in collaboration with BNP Paribas and a company called Selective here in the UK. And what we are showing here is returns generated by the S&P 500 over a 10-year horizon versus returns generated by firms with a higher proportion of brand value relative to total enterprise value. And that comes from our Global 500 study, which has been running for the last 20 years. As you can see, firms with a higher proportion of business value made up by brand outperform the S&P 500 year on year. And that's a very strong argument, I think, for why brands and reputation are important and why companies should invest in brand as an asset. I mentioned our Global 500 study. What we also publish is a ranking of the top 50 most valuable brands every year. And we've been doing that for the last 11 years now. We published these rankings in June of this year. And what I've presented here for you is the top 10 most valuable brands in South Africa for 2020. We can see that MTN retains its place as the most valuable brand in South Africa with a value of 49.4 billion rand. This is largely driven by very high scores in brand equity according to our global research tracker. Our research covers 10 industries globally in approximately 32 countries, 4 of which are covered in the South African market. As you can see, there's not a huge amount of movement in the rest of the table in terms of ranking changes. But what we do see is a significant amount of red on the screen here and in that middle column. And what that indicates is year-on-year declines in value. So the reality is that much of the change in value is as a direct result of the increased risk climate in South Africa. So things like weaker currency, credit rating downgrades, these are all factors that negatively influence brand value, just as they would negatively influence the value of any other asset that's based in South Africa. Jeremy alluded to earlier a concept called brand strength, which is part of the methodology in valuing brands. Essentially what the brand strength is doing is taking 20 to 30 metrics across a range of stakeholders in order to benchmark how one brand performs against another. You could think of it as how the brand sits in the hearts and minds of its stakeholders versus the brand value, which is the actual financial value that a brand can be bought and sold at. So if we look on the left-hand side, you can see the top 5 strongest brands in the South African market. And on the right-hand side, what I've pulled down is the top 5 most reputable brands in the South African market. So interesting to note that Vodacom is the strongest brand. And according to our research, it's also the most familiar brand in South Africa. I know that Vodacom is doing reasonably well. They added approximately 500,000 customers in the last quarter, so that's really strong growth from them. Capitec, who were previously our strongest brand in the study, have now fallen to the second strongest brand in South Africa. However, Capitec has the 6th best reputation of any bank in our study. So that's, again, a global study covering global banks. And on a like-for-like basis, when you account for the way different countries rate brands, Capitec comes out as the 6th most reputable in the world, which is an extremely strong result for Capitec. Just to highlight that we aren't just researching South African domiciled brands, but obviously brands that operate in a South African context. And that's important because consumers in a South African context can choose between local brands and international brands. So Emirates, for example, it's highly reputable, provides excellent customer service, but we do not publish its value in the South African table. Rather, it's published in the Middle Eastern rankings as the brand is domiciled there. Of course, we can't talk about brand value in South Africa with talking about the impact or the potential impact of COVID on all of these brands. And I think one way of looking at this is trying to assess the impact past recessions and downturns have had on various industries. So at Brand Finance, we have been tracking the value of brands and businesses continuously since 2007. That is when we first published the Brand Finance Global 500 rankings of the most valuable brands in the world. And during that time, we have tracked how brands have fluctuated through three major economic downturns experienced. So that was 2009, 2012, and 2016. And what we have found is that brand strength, so again, the way we measure reputation and health of a brand, is highly correlated with the resilience in economic downturns. So a notable feature of this long-term study is that the stronger the brand is, the more resilient they are to economic downturns. So we found that over a period between 2008 to 2019, the consistent 100 biggest fallers in value in our global study have an average brand strength index score out of 100 of 66. In contrast to that, the 100 biggest risers over that same period have a brand strength index score of 72. So again, that piece of information just highlights why it is in fact extremely important to consistently invest in your reputation and your brand. In March, we conducted an analysis categorizing potential sector-specific impacts as a result of the impact of COVID-19. And you can see here in the red bar chart, according to returns between January and March, sectors such as airports, oil and gas, and hotels were particularly badly affected. And I think, intuitively everyone can see that. Sectors such as household products, utilities, telecoms, and food, for example, were only affected so far as their supply chains were impacted at the time. We subsequently extended this analysis to assess the rebound between March and July, and that you can see in the green line graph above the red bar chart. And sectors such as technology, spirits, leisure and tourism have performed well since the global lockdown has eased. In a strictly South African context, between January and March, the retail industry, the banking industry, technology, engineering, and mining sectors experienced the largest declines, and I think that comes as no surprise to everyone. However, between March and July, these sectors have made very strong recoveries. When you combine these numbers between January and July, we can see that the majority of sectors have not recovered to levels that were previously seen in January. And the likes of airports, oil and gas, and hotels are still suffering hugely, whereas some sectors, such as technology, commercial services, spirits, and beers, are actually performing extremely well. So the next logical question then is how to grow or at least maintain your brand during the onset of COVID-19 and beyond that horizon. I think many people on this webinar in their businesses would have experienced cuts to your marketing and advertising budgets. However, there is a very strong argument that is the incorrect line of action to take. And intuitively, we have 3 points to raise. So firstly, the cost of media usually decreases during recessions, so it becomes cheaper to actually advertise. Secondly, consumers are more receptive and have more time to absorb brand messages. Whether that be because they are at home in front of their TVs, for example, and not doing anything else, or perhaps because there's less advertising or less demand for advertising in the market. Consumers are more receptive to brand messaging during downturns. Thirdly, if the messaging is appropriate in terms of tone, it can have a much more powerful emotional effect. And we always argue for the sweet spot in branding to be in the middle of functional and emotional messaging. Additionally, there's a wide range of research that justifies maintaining or increasing marketing budgets. So there was a McGraw-Hill research study which assessed 600 companies in an economic downturn, and it found that businesses that maintained or increased marketing expenditure or investment into their brand increased revenues significantly once the economy had recovered from its downturn. Further evidence is provided by Les Binet and Peter Field, and they suggest that when share of voice is greater than share of market, brands begin to grow. And intuitively, this makes sense. Particularly in economic downturns, spending when your competitors are cutting back enables greater potential impact of any given campaign on a like-for-like basis. So to bring it back to the research that Brand Finance conduct each year, and to go along with the theme of how to grow your brand post-COVID, we then ask the question, which brand attributes are the most important to invest in? And what we have on the right-hand side here is a series of 13 image attributes that we research across various industries and again across various geographies. And what we try and do here is link these attributes to brand consideration. I did already mention earlier in the presentation the importance of consideration, but just to remind you that in 65% of cases, consideration forms the closest link to base revenues or sales. So a growth in consideration equates to a growth in revenues for your business. Therefore, the question is, well, what drives brand consideration? And what we do is a statistical analysis, which is called factor analysis, followed by linear regression. And essentially, we take these 13 metrics and we group them into more easily manageable buckets. So the first bucket is what we've dubbed consumer champion. The second bucket is innovation. The third is profit hungry. And the fourth is digitalization and product range. And what we've done is correlate these metrics to brand consideration within the banking industry in South Africa. I've chosen the banking industry in South Africa because I think it's probably the most salient industry for everyone on this call. Everyone will recognize all the banks, and I'm sure everyone on this call uses their banks, on a day-to-day basis, if not a week-to-week basis. And what we can see here is that the grouping or the factor, consumer champion, is the most highly correlated factor with brand consideration. The second being digitalization and product range. And what this means is if you want to grow brand consideration, you need to grow the attributes that sit within consumer champion. We can take it a step further, and what we can do is graph the relationship between consumer champion performance and how brands are rated on consumer champion versus the brand consideration they generate amongst consumers. So what we can see here is that Capitec overwhelmingly is rated as the consumer champion bank in a South African context, and that is really what drives consideration for the bank. So where you really want to operate is the top right-hand quadrant here, or the green quadrant. That is the sweet spot for any banking brand in South Africa. However, we know that not all banking brands in South Africa can be seen as the consumer champion. So you can see First National Bank, for example, according to this graph, has very high consideration, but it's not seen as the consumer champion. However, where First National Bank does perform well is through its digitalization and product range. So it's seen to have the most effective digitalization and the widest and best product range and services range, and that is why it is highly considered in a South African context. You can see Capitec does not necessarily play in this space, but where it does own is being that consumer champion. I'm now going to hand back to Jeremy briefly to introduce the concept of soft power for you today, which is another interesting study that Brand Finance has conducted over the past year.
Thanks, Dec. I think you'll realize that when you look at all that data, it's important to make the point that still in Southern Africa, especially, there aren't too many people who sit on excos or boards of directors who have the depth of knowledge of branding and reputation. Also, there's often the issue that a lot of people, especially older executives, think marketing is advertising and a fuzzy issue, and that the marketing budget is actually a big black hole. And that's why Brand Finance has a positioning statement that says, bridging the gap between marketing and finance. And this is often a very crucial point, as Declan has been saying, to be able to talk to the financial world, to engineers and to lawyers, but explaining to them what's going on. As you heard earlier, MTN is a brand worth just under 50 billion rands. Now, when you're looking after an asset like that, and in some companies the brand is the most powerful and the most valuable asset, you better have a team around it who know exactly what they're doing. When we move on to soft power, this is of course a concept that's been around for the last decade or so, and it really talks about reputation. It's especially applicable to countries. And I'm going to just read you the definition of the whole thing. It's a nation's ability to influence the preferences and behaviors of various actors in the international arena, that's states, corporations, commuters, and the public, of course, through attraction or persuasion rather than coercion. So you have soft power, and then you have hard power. Now, Declan's going to explain how this is measured, how the metrics are put together. But what it means is we can actually have an index of all the countries in the world, and we can compare them. Here you can see the brand summit that was held at the end of February in London, and the brochure that was produced on the whole thing. And main countries like South Africa were mapped and put in place. A very interesting paper was presented by Professor Nicola Klein, who was at Gibbs until June, of course. And you can see there the panel of speakers, and the keynote speaker, bottom right, was Ban Ki-moon, the former head of the United Nations. And you can see second from top left is Sebastian Coe, the well-known athlete. And this is where the various speakers look through their lenses of talking about soft power and the impact this can have on a country and the importance. Now in South Africa, we're talking a great deal at the moment about the need for inward investment. We need investment to get the country going again, to get the economy humming, to create jobs. Now, the soft power reputation of South Africa plays a major part in influencing overseas potential investors. Now, remember, they have the whole world to look at, not just South Africa. So this is where we have to up our game, as it were, to project ourselves as a very, very suitable place for inward investment. Dec, are you going to take it from there?
Yeah, thanks, Jeremy. So the research for the soft power study covered 54,000 respondents among the general public, as well as 1,000 specialist respondents. So that's industry leaders, academics, for example. We covered over 100 countries to ascertain the opinions of people worldwide. But what we did was focus the rankings on 60 subject countries. We are now, this year, expanding that to 130 countries researched with a focus on 100 countries. What you can see on the screen here is that we covered 10 key pillars. So familiarity, reputation, influence, business and trade, governance, international relations, cultural heritage, media and communication, education and science, people and values. And within those 10 key pillars, there are various attributes that were specifically researched. And what we have here is the Global Soft Power Index Top 10. And as you can see, the US is the top ranked country by soft power. For reference, South Africa is ranked 36th out of 60. Germany, the UK, Japan, and China make up the remaining top 5. And just to highlight the difference again, it is worth noting the difference between economic power, or GDP, and soft power. So as you can see here, India are the 5th largest economy in the world. So they have a lot of economic power. However, they rank 27th by soft power, so underperforming there. By contrast, Switzerland is a very small economic entity in GDP terms globally, yet it outperforms and ranks 8th in soft power. If we focus a little bit on South African soft power, as mentioned previously, South Africa is ranked 36th out of 60 nations. The key attributes for South Africa are familiarity, influence, and international relations. So that's where it outperforms its overall rank. Individual metrics within these categories where South Africa performs particularly well are people view South Africa as being easy to do business with. That's ranked 20th. People think South Africa are leaders in sport. That's ranked 17th. And finally, people think South Africans are friendly. So they rank South Africa 24th across the study. However, South Africa is ranked 37th in governance, which is a particularly low score. And South Africa actually performs worse when we zoom in on the attribute ethical standards and corruption, where South Africa ranks 53rd out of the 60 countries. So you can see that is a metric where South Africa is really pulled down. And ultimately what this says from a private entity point of view is that, you know, there is an opportunity for brands based in South Africa to leverage off of the positive soft power that South Africa has in certain aspects of the ranking. What we have done here is focused in on the BRICS nations for comparison, and we have modeled country reputation on the y-axis and the country's global influence on the x-axis. So from a BRICS perspective, soft power influence globally is restrained by relatively poor reputations across all of the BRICS nations. So you can see all the BRICS nations are below that trend line in the middle there. Just to highlight the point on that I previously raised is you can see Switzerland at the center and the top of the page here with an extremely high reputation, but perhaps they're not using that to generate sufficient influence in the world. So, you know, really where you want to be is exactly on that trend line, performing relative to your reputation, showing how much you can influence the global stage. I'm just going to hand back briefly again to Jeremy before we take any of your questions. Again, just a reminder to please feel free to raise your hand or put questions in the Q&A box.
Thanks, Dick. Just to close off, some of you will have seen an article that I wrote in the Financial Mail in South Africa last month, where we talked about mergers and acquisitions, because that is something that obviously goes on all the time, but as a result of the times we live in COVID, there's probably going to be increased M&A activity. Now, first of all, people say don't waste a good crisis. You can recalibrate your business, recalibrate your portfolio of brands. Sometimes you might want to sell off brands. Sometimes you might want to acquire brands, take out your competition if you can. Some people have deeper pockets. Some people are struggling to survive. So I wrote a little piece, partly in response to Michael Katz, the senior partner at Edward Nathan, who talked about M&As from a legal financial perspective, which he's absolutely right about, of course. But then I wrote about it from the branding perspective, because there are some horror stories if you go back through history. One of them was when Rolls-Royce had an automotive division, because of course Rolls-Royce are best known for aero engines. They supply both Boeing and Airbus. But they wanted to sell off the Rolls-Royce car brand and the Bentley car brand. And Volkswagen bought the one brand, but in the due diligence, they forgot to buy the trademarks. So they actually had the factory, the design and everything, but they didn't have the actual trademark, which of course was a total disaster and caused great concern. Another thing to talk about is that Zoom, which perhaps most of us had never heard of at the beginning of this year, and now we're on a Zoom call and it's part of our lives all the time. And what's happened to Skype? It seems to have faded away in some areas. But Zoom is quoted on the New York Stock Exchange. And in March, investors started piling into Zoom. The only thing was there were 2 Zooms listed on the stock exchange and they were piling into the wrong one. So the wrong one went up something like 3 times and the real one went up only 30% or so. And in the end, the SEC jumped in quickly and calmed things down and explained what was going on. So my point here is that mergers and acquisitions are crucial. Often it's the brand that you want to buy, and sometimes who cares who owns the brand? Are you really worried that a Volvo today is owned by the Chinese? Are you really concerned about the Mini being owned by BMW? It probably adds huge value to it in any case. So there are all sorts of aspects you've got to consider. So we come back to the title of this presentation: Are brands and reputation important? If after this last 30 minutes you still think they're unimportant, well, perhaps we can talk offline. It might get a bit rough there, but thank you. Are we going into the Q&A now, please, Vicky?
Yes, Jeremy. I think Declan's going to manage the questions there. And if anyone does raise their hands, I'll just come in and help unmute and let them chat to you guys.
Sure. Jeremy, we have a first question from Pagamilia, which says, what do you think of the Clicks brand now, and how will they be affected by their recent bad advertising? Do you want to field that one?
I think it's a work in progress. I was actually asked to talk on ENCA on Friday morning as the whole thing was breaking. And of course, since Friday morning, it's changed quite dramatically. I think it's interesting that the brand that caused the trouble, Mensime, which is owned by Unilever, of course, then distributed through Clicks, and Clicks put out the digital ad, which has caused the furor. I think if you look at the Clicks share price, I speak under correction, but it actually hasn't changed too much. And I think Clicks is such a strong brand, I think it'll recover quite quickly, but obviously they have huge reputational issues here. I see that one person has been fired as a result, but it's asking all sorts of questions about Clicks and other corporates, how they could have allowed something like this to happen, because it just should not happen, and we should know better by now, and B, how you actually handle the whole thing. Now, the chief executive has gone up front and he's spoken and he's put himself out there, but has actually almost generated more criticism by some of the things he said. And I'm afraid at the moment, we're into such an emotional phase, and it's not helped by the EFF. And we've got racial issues, we've got emotional issues, we've got issues of violence, and it really is a bit of a toxic situation at the moment. I just refer you to Professor Adam Habib, the Vice Chancellor of Wits University, who spoke at some length this morning on one of the television programs. And he said, we really have got to be more grounded. Yes, everything that is racial has to be moved off and moved out. It is unacceptable. But we can't allow 1% of the population to terrorize a country, to terrorize a company, and to close down their business and do harm to it. So it's a work in progress, and I think Clicks is the latest example. Of course, we had H&M a couple of years ago. We all, I think, have to work at making ourselves more sensitive, but working together as a nation, and then we'll be better for it.
Yeah, and Jeremy, if I could also just jump on there, because we've got a couple of follow-up questions around the CEO debacle at Old Mutual and how that affected brand reputation. And I think this speaks to the Clicks case as well. What we've found overwhelmingly in our research is that stronger brands, brands that have invested in growing and protecting their brands, are more resilient to external shocks. We've seen it with the likes of the emission scandal at VW, for example, in the States with the Wells Fargo account scandal. And what we've seen with Old Mutual is that, sure, the CEO debacle went on and on in the media, and I think definitely negatively impacted investor relations in terms of the investor community. But our research indicated that the overall consumer experience of the day-to-day dealings and the week-to-week dealings with Old Mutual as a brand has been improving over the last year. So sure, the CEO debacle was top of mind, particularly in the media, but really it was only impacting one relatively niche stakeholder, that being the investor community. And I think that was reflected in the suppressed share price of Old Mutual. However, when we're looking at the overall brand value and assessing the impact on all other stakeholders, consumers being the key stakeholder, there was very, very little impact of the CEO debacle on those other stakeholders. We've got quite a few questions. I've got one from Christopher Gilmore. Is SA soft power relative positioning rising, falling, or pretty much staying the same? I can answer that one. The study that we've just conducted over the previous year is the first study of its kind at such a large scale. So at the moment, we've got a peg in the sand, if you will, to measure relative performance next year. As I said, we are extending the study later this year to include more countries and a higher sample size. And only then can we really see the relative movement of South Africa year on year. John Murphy is asking, why are brand valuations by Brand Z that were reported in the Financial Mail so different to the brand valuations that Brand Finance just showed on screen? For example, F&B is 50% higher than MTN, according to Brand Z. So really, there's 2 points to raise there. The first is the definition of brand. Brand Finance works on a much more nuanced definition of what the brand asset is. So we define brand as the trademark, trade names, and associated IP that can be transferred and that is separable from the business. And that is as close to the strict accounting definition as you can get. Brand Z operates on a much looser definition of brand, where they try and capture the wider impact that the brand has throughout the business, but the impact that cannot be transferred. So I think a good way to highlight this is, I indicated a few slides earlier around the CEO pay. We know that strong brands attract and retain employees, but if a third-party business were just to license a brand, it doesn't necessarily mean that they will be able to attract and retain employees in the same way that the original brand owner can do. So that benefit is not necessarily transferable from the licensor to the licensee. The second thing worth raising there is just a difference in methodology. So we use what's called the royalty relief methodology. That is widely accepted by tax authorities, accounting firms like the Big Four. In fact, our CEO has used the royalty relief methodology in the Amazon IRS case as an expert witness. Brand Z use a methodology where they are effectively trying to apportion profits to the different assets of the business. It's sometimes called the income split methodology. So those are the two primary differences of why our valuations differ. But again, just to reiterate, we are one of only 2 firms that are fully ISO compliant within our valuation methodology.
I just want to add to that, Dec, that it's interesting on the Brand Z rankings, you see Nando's right up there. And I'm sure everyone thinks, wow, Nando's is a great brand, and they're quite right. We don't mention it at all. And the reason is that we are unable to get access to any financial data. Some of you with long memories will know that there was a short time when Nando's was quoted on the Johannesburg Stock Exchange. They then took it private again. So it is a private company. It's operating in nearly, I think it's 30 countries around the world. And I've known Robbie Brosen, one of the co-founders, for a long time, and also Jeff White, who is the CEO for EMEA countries. And I spoke to them only 6 months ago saying, are you able to release financials to us? So we would like to include you. And they said, sorry, we can't give you the financials. So there's another difference in the methodology between the 2 companies.
Correct. Thanks, Jeremy. Zandelia Sabaya's got a question, which is, how do you value a brand in terms of buying and selling during M&A? And the follow-up question is, how much influence does a brand have over the valuation of a business? So we showed a slide right in the beginning of the study where we used what's called the royalty relief methodology. And essentially it's based on the premise that typically when you license a brand, you do it in the form of paying a royalty or a percent of top line revenues. So the methodology is based on that assertion. So essentially we try and determine an appropriate royalty rate for each brand and then use a discounted cash flow methodology to get the brand value. And for the follow-up question of how much it influences business value, particularly in M&A, there's a huge impact. If you look at the stock market at the moment, you'll see a massive difference between the market cap of a company and the book value of a company. And that all of that space in between, people tend to call goodwill, but in reality, there are a range of different intangible assets that sit in that gap between market cap and book value. And overwhelmingly, the brand is the largest asset, not just within that space, but also when you take into account book value of tangible assets for a business. So it plays a huge role. And we particularly see a lot of work coming through our door seeking accurate brand valuations, so an M&A transaction can be priced correctly. Another question, how often should brand strength be measured, and can it be done in-house? I think, Jeremy, would you like to field that one?
I think it depends on the kind of industry you're in. If you're in fast-moving consumer goods, as you know, if you're someone like Unilever and you're a brand manager in Unilever, you actually get the sales results for your brands the very next morning, so you can track what's going on. And then a lot of other companies have tracking, especially if they're running ad campaigns or whatever. So it varies across the board from the B2C, the business to consumer, the business to business. We often say, well, just as you have quarterly financial results or half yearly or yearly, it wouldn't be a bad thing, depending, I stress, on the industry you're in, to have an annual valuation to see what's going on and to measure what's going on. But one of the key things, especially in these very volatile times we're living in, is to track what's going on, to know where you stand. It still amazes us when we go to a lot of companies who inquire about brand valuation, and one of our very first questions, as Declan has alluded to, is, what research have you got? And it's still amazing how many companies have very little or even no research at all. And that obviously is an essential part of our assessment of any brand value.
Correct. So Ben Groenewald is just asking us to highlight the difference between brand equity and brand value. So there is quite a clear distinction between brand equity, brand strength, and brand value. So brand equity, for the most part, focuses on consumer perceptions, but also perceptions of other stakeholders. And the way you could think of it is how the brand sits in the hearts and minds of consumers and other stakeholders. Brand strength is a more holistic view of the brand. So it includes brand equity, but we are also looking at the level of investment the brand is receiving and the level of performance the brand can generate in terms of ability to generate revenues or higher price premiums. The brand value is the actual asset value of the brand that can be transferred in an arm's length commercial transaction. John Povey is asking, how much of brand reputation is perception compared to true values of the organization? Does our analysis examine these differences? It's a very good question. What we take the view that because the brand strength is a holistic view on how strong the brand is relative to its competitors and its geography and its operating segments, we do take into account not just consumer perceptions, but also other fundamental metrics underlying the strength of a brand. So while it's true that an organization may hold internal values that might be separate from the perception or how they're perceived externally, ultimately you want to bridge that gap. You want to hold quality values internally and then communicate those values externally, so your reputation is aligned from both an internal stakeholder point of view as well as an external stakeholder point of view. Jeremy, I don't know if you have anything to add to that.
I think one of the most complicated words in the English language is perception, because each of us have our own perceptions of every subject that we think about. And I remember once seeing a slide which was simply perception equals reality. And I think that's what the situation is. Each one of us, whatever we perceive about a subject, that to us is totally real. And one of our challenges, and one of the challenges of any brand, of course, is to manage those perceptions to their own advantage in a positive way. And that, I guess, is part of the challenge of marketing, and why marketing is so crucial, especially today when we've got the added channels to market of digital and what's going on. And those markets, of course, are basically uncontrolled and unmanaged, as we're seeing from what's going on with Facebook and TikTok and Twitter at the moment. Everyone has a voice, everyone has the opportunity, and some of those people are going to be mischievous as well. So somehow companies and brands have to try and manage their way through this. And if they can, although it's virtually impossible, control the perceptions.
Yeah. Christopher's asking if the correlation between CEO pay and brand strength is mirrored in the South African market. The answer is yes, although the correlation is weaker than in the US market. And I think that's largely due just to volume, essentially due to data points. The US is blessed with a huge range of brands. So for example, in our Global 500 study, approximately 200 of those brands are US based, and we don't have a single South African brand within the top 500. So, the trend is mirrored in South Africa, but the correlation is slightly weaker than that of the US.
I find it fascinating to add to that the number of South African companies that have moved offshore, and I guess the latest is Naspers, and suddenly the chief executive gets paid world rates rather than South African rates. But that's probably another subject which we should talk about. But it is fascinating. If you own a company and you can take the listing across to London or wherever, immediately you can expect your salary and your package to go up 10 times plus. So that's perhaps an incentive to chief executives to take their businesses out of South Africa, but that's also a negative, which is sad.
Nokutula is asking, is the most important issue to build a strong, resilient brand in order to not be affected by external shocks? Does not that then have unintended consequences of a no-care attitude from large companies, which translates to bad decision making? It's a good question. We would argue that there are a huge range of benefits for investing and building a strong brand. One of which is that it is more resilient to external shocks. I mentioned Old Mutual earlier in a South African context, the VW case with the emission scandal, which was a huge, global issue. VW's brand strength and brand value rebounded quite significantly in the period of 18 months post that scandal. And essentially the first half of the presentation was just underlying why it is important to invest in your brand and create a strong brand. Obviously, it affects a wide range of stakeholders, that be consumers, financiers, employees. There are huge benefits and strong arguments for why you should be investing in the strength of your brand and the value of your brand.
And I think at the moment as well, it's very interesting when one watches international business television, seeing the guys from especially the travel world talking about the different speeds of recovery around the world. So China seems to be recovering the fastest. And this is where if your brand has got a good geographic spread, and hopefully it's in some of those countries that are recovering faster than others, it's going to be better for the brand. But if a brand is just focused on one provincial area or just in one country, it's extremely vulnerable if things go wrong. So you need to try and spread your risk as well.
We've got another question from Sibusiso, who's saying, when we look at the 4 categories that we need to invest in, so the consumer champions, innovation, digitalization, and profit hungry, do you think these cut across all industries, or should we be looking at brand building per industry? So one distinction I should make is that kind of that 4th one that you talk about being profit hungry was negatively correlated with brand consideration. So the more profit hungry you are, the less consideration people have for you. The other distinction I need to make rather is that it does differ industry to industry. You know, there will always be hygiene factors, if you will, that consumers look for in brands that cut across industries, but the example I provided was strictly applicable to the banking industry. But we have run that analysis across other industries in South Africa and indeed globally. And you can see various white papers on our website, which is www.brandfinance.com. There are various thought pieces around similar topics there. Zandile is asking, does brand reputation mainly affect listed companies, or is that any company? Jeremy, do you want to field that first?
Well, I think yes. As we were saying earlier, it affects absolutely everything. It affects the individual, through to the company, through to the country, whether listed or non-listed. As I mentioned, Nando's is non-listed, but I think it's very large in a lot of our lives. So what we're saying now is that as part of all of our lives, from an individual to a country, branding and reputation is very important, how we handle ourselves. Often if I give a presentation on personal branding, you think of each of you who are watching this webinar, your own position in your company. After all, you're wanting to perhaps climb the ladder. So how do you project yourself as a brand? How do you behave as a brand? Have you analyzed how you are perceived as a brand? So this is where it's totally interwoven, as I would argue, into our way of life today, not just listed companies.
Agreed.
Hi, Declan, it's Vicky. We've got a few more minutes before we need to wrap up. I've seen on the chat group, there's a question from Sashen, which I thought was quite nice, around what about personal branding? And if you and Jeremy can maybe chat a little bit about that.
Sure. Jeremy, would you like to field that first, and I can follow on from you?
Really then carrying on from what I've been saying, that we as individuals all have reputation, whether that's with our family, with our workmates or whatever, or if one is out in the industry, out in the media. And so it is important sometimes to look at yourself in terms of a brand. I remember one of my former colleagues, Andy Milligan, wrote a book on David Beckham, the footballer, as a brand. And he analyzed him as a personal brand. And he analyzed him from being a footballer to being a sportsman, to being a family man and a father, and then right through to being actually a statesman and an impresario. So if you know about branding, it's not always easy, but try and stand back from yourself and analyze yourself in that context. And it's interesting to see perhaps how one is perceived and how one wants to be perceived, and then try and analyze the gap. Back to you, Dec.
Yeah, agreed. You know, and personal branding and business branding are funny things in that they can take quite a while to build up a strong reputation, but can be decimated in a very short space of time. You know, unless you have a long-term history of kind of strong reputation and strong branding. But just to reiterate Jeremy's comment there, you know, your own personal brand and your own personal reputation is what everyone else in the world perceives of you, and is what you leave behind at the end of the day. So it's a hugely important aspect, you know, not just in your professional life, but you know, also in other aspects of your life. And we have done various studies to try and you know, determine an individual's personal brand value. So we've done it for the likes of Cristiano Ronaldo. We've done it for the royal family. We've done it for Prince Harry and Meghan Markle. And again, you can see all of those studies and those results on brandfinance.com.
Just to add to that, you know, one of the wealthiest men in the world is Warren Buffett, and he has a lot of very quotable quotes. One of them is, when the tide goes out, you see who's swimming naked. But another one is, it takes years to build a reputation, and you can destroy it in minutes. And now we know that digitally you can destroy it in seconds. Warren Buffett, Sunday, 10 days ago, turned 90, and he's still the chief executive of Warren Buffett. So just, Vicky, I can see you're hovering there, but people who say you should retire at 60, 62, 65, absolute rubbish. And you only have to look at Warren Buffett, as I say, 90 years old and going strong. So young guns like Declan have got many, many decades to go.
Thanks, Jeremy and Declan. Declan, is there anything else? Do you want to answer any other pertinent question you feel really needs to be answered before we close off?
No, look, to be honest, there's so many questions unanswered. I'd be more than happy to field any questions. If anyone would like to just drop either Jeremy or myself an email. Our email addresses are our initial.surname@brandfinance.com, so d.ahern@brandfinance.com, or feel free to reach out to us either via the Brand Finance website or LinkedIn or any other channel.
Fantastic. Thanks so much. We'll put those emails in the thank you email that will go out to everyone as well, so that they also have that there, together with the recording of today's session and the slides. Declan and Jeremy, thank you so much for your time this morning. I think it was a really valuable presentation and a good awareness, I think, for many. If I see from the chat comments that were coming through, I think everyone has enjoyed it, and it's raised some good thinking to go back and look at brand and reputation, especially now, I think, in the current world, and in reinventing our businesses and our branding as well. So thank you so much for such an informative presentation. We look forward to hopefully having you again with us. And to all our attendees, thank you so much for joining, and we will see you all again next week, same time. Thanks, guys.
Perfect. Thank you. Thanks for having us.
Thanks, Vicky.